Five, four, three, two, one. Thunderbirds are go. Welcome, Bill, to the
Thank you.
Private Equity Fundcast. So today's guest, Bill Snow, author of Mergers and Acquisitions for Dummies, which, by the way, Dummies has always been, I love that the marketing of it, but it's not really, the books aren't for dummies, clearly, and they're not written by dummies, which is kind of a funny, I don't know, funny to play on words, I guess. I remember the originals. I think we're both old enough to remember, I think, why they started that way, but
MS-DOS for Dummies, I think, was the original one.
yes, I will tell you in those days, I was doing seminars for a large database company when PCs first came on from on the market, or in view, and from we're mostly a mini computer shop. And we had a slide that we had a version of the product that ran on MS-DOS, and somebody raised their hand and they said, "Hey, who is this Ms. DOS everybody keeps talking about? Is she some industry analyst that I need to know?" Which is like, I didn't quite know how to answer that. So welcome, Bill.
Thank you.
I'd love to talk a little bit about your background. You got a great background in M&A. So let me turn it over to you for a second to talk about your background and kind of the genesis of the book.
Sure. No, happy to do that. And thank you for having me. This is a real treat. When I got out of college, I have a finance degree. I had no idea what I wanted to do, probably like a lot of people. So I kind of bounced around. I tried a lot of different things. I had some sales jobs. I ended up working for a retailer, actually moved to the Southeast for a while. And we were rolling up mom and pop retail operations. Was a bigger company. And it's funny, I didn't think about it because I was mostly on the management side at that point, but a lot of what I was doing was the integration, post-merger integration of these little businesses that we were buying up, which of course dovetails into what I do now. I developed an interest in the genesis of businesses. Where do businesses come from? Obviously, venture capital is right in the middle of that. So I started working for friends and family funded businesses, angel funded businesses, eventually venture capital funded businesses. I worked for a matchmaker between venture capital and entrepreneurs. And you end up getting a lot of experience, a lot of business experience, how to sell, how to manage, how to read a balance sheet and so forth. But I hadn't figured out what I wanted to do. A friend of mine, after the venture capital thing wound down, went to work for a middle market investment banking firm, and they needed somebody. And so they recruited me, and I very wisely turned down that job, I think 4 or 5 times before the owner of that firm caught me in a moment of weakness. And I said, okay, fine, I'll go be an investment banker. So that's how I got into the investment banking world. Everybody always says, well, I want to do what you do. I want to do your career path. And the first lesson for any young people is don't look at somebody what their career path is, because you can never repeat it, because a lot of times we have a lot of happy accidents. You have to be open to different ideas that maybe you haven't thought about. And that's why casting a wide net, talking to a lot of people and so forth is always very beneficial. So I got into middle market investment banking almost 20 years ago. I was on the execution side. So I divide M&A, the sell side work into 4 different buckets. There's the origination, finding the deal, putting the materials together, executing the transaction, so making the calls, getting the materials out, getting the offers, negotiating, closing a deal, and then what the house does, providing office and email and phone and insurance and all that kind of stuff that you need for a business. So I was on the execution side, selling mainly. Also did some buy-side work. Probably about half my engagements were buy-side work. So I got experience both from selling companies and making acquisitions. And a few years before I segued into middle market investment banking, I wrote a book on venture capital. I was upset about a business meeting that did not go well. And this chairman asked me, what the blank do you know about venture capital? And so I wrote this. It was going to be an article. I didn't know where I was going to put the article, but the article kept getting longer. And I eventually turned it into a little book and wove a little narration through it and had some fun. And I called that Venture Capital 101. I gave that away for free as a PDF. Back in 2003, and it got forwarded all over the internet. I was a very, very, very minor viral internet hit before that was a term. And a few years after that, so this is now after I got into middle market investment banking, Wiley Publishing got a hold of that little booklet on venture capital. They were looking for somebody to write a book. And so they reached out to me. And so that's the other lesson too. If I would have put a plan together to do this and be able to publish with a major publisher, never would have happened. I did something, instead of talking about it, I did it. I demonstrated skill and ability, not just understanding the venture capital game and all of that, but I have a little bit of a flair. I have some talent when it comes to writing. I was able to demonstrate that. So you go from talking about what you will do to actually doing. And for me, it's been very rewarding because so many more doors open up. So Wiley contacted me. It was a bit of a long gestation. They had one idea for a book. We parted for 2 years, and they came back 2 years later with a great idea, which was my idea, M&A for Dummies. And so I wrote the first one in 10, came out in 11, and just a few months ago, we came out with the second edition. So there's my very exciting career recap for you.
That's actually a pretty good recap. You did it at good speed. I'm a Bostonian, so I prefer fast talking, basically.
I can't stand these videos. Good. I'm glad you're saying that. People watching this, when you do the videos, they do this and people say, and just get to the freaking point, man. Let's go. So hopefully I get to the freaking pointers. It drives me nuts.
So two things. One, I actually bought a copy of this book for a friend of mine, so that runs a small business. That's
awesome.
Awesome. It's like in a completely different space. So they're in there.
I made a buck off you. That's awesome. That's what.
That's the funny part with people don't realize, like the titles. It's like I made 57 cents on this guy.
Yeah. Thanks.
Which is good.
So if you buy a few more of those books, I can buy a cup of coffee now these days. So that's great. So I appreciate it.
Can you though? I mean, the price of coffee is gone. I don't think you can get out of Starbucks for less like $3.75 at this point. And post COVID, you can't even put your own cream in. So I want to get on a rant here, but
in downtown Chicago, it was over $4 for a cup of coffee. Yeah. So it's anyway.
There you go.
Nothing we can do about that.
So I thought we'd focus on what you had called part 5, the part of tens. And so specifically, I just dive in this. We're going to do this as a 2-part episode, but part 1 here, we're going to focus on transaction pitfalls. Part 2, we're going to talk about the lurking problems for sellers. So and I'm going to do that. I'm going to be the interviewer guy here, since that's the only thing I can do on this. So all these are really good. These are simple points that I think people just miss out on. And this was not to spoil the reveal or anything like that. As you talk to somebody who's a small business person, a lot of these things hit home, like, oh wow, and we're going to talk about most of these things, like working capital adjustments. Like that was one of those, like, man, they didn't even think about that, right? They sort of run their business how they run their businesses, and we've seen a lot of founders, even in surprisingly large companies, they run their business by what's in the checking account. If I got $3 million in the checking account, I did fine. If I got 100,000 in the checking account, I got a problem. They don't really focus on the rest of the stuff, which becomes a big problem when a seller comes in, because it's a different world.
It is, and happy to go through that. But you're absolutely right. The way that a business owner runs the business is quite often very different than the way that a buyer will value the business. And business owners, they like the balance sheet. They like the income statement. They tend to have a pretty good understanding of that. This other thing called the statement of cash flows or cash flow statement, whatever you want to call it, that is just the redheaded stepchild in their world. I've known business owners who will get a software package for their accounting, and they purposefully will not get that because it might cost a little bit extra. That's the first thing I want to see when I review the financials.
Sure.
And they don't want to do that. Almost every transaction I have worked on, at some point, usually after it's done or close to being closed, the owner of the business, or maybe the president or someone high up who's running the business, will pull me aside and say, I wish I would have known all of this beforehand, because I would have run the business differently, because now I understand how businesses are valued. And it's not that it's a sea change or radical change, but it is quite different, the way you value business versus the way you run a business.
Oh, for sure. Especially as you get, I don't want to say professional management. It's just, when you transition from somebody who started the business to somebody who didn't start the business that's running it, their approach is very different.
Sure, absolutely.
So the intrinsic knowledge versus having to learn it from the outside. So let's start from the top. So This is one of my favorites, by the way. Is the deal too good to be true?
Absolutely, and that is something, it's a tricky thing, because a lot of times when we run a process, what we're looking for is the buyer that has a strategic imperative. So if you go out, you talk to the market, and you ascertain their level of interest, you talk to all the viable buyers, you get the materials to them, and you get back offers. And an offer might be, we're not interested. That should be a data point as well. But you want to clear the market. You want to get all the viable reactions and responses and how people might value a business. And so quite often you'll find a buyer who's putting together something that is a value that is higher than all the other offers, substantially higher perhaps. Then you have to ask yourself, is it too good to be true? Why are they doing that? Are they throwing a big number out there trying to go to due diligence, which means that you have, as the seller has to provide assurances that the seller will not talk to any other buyers. That's called exclusivity. And then are they going to methodically whittle that price down into something smaller? And you have to ask yourself, can this buyer really close this deal? Not all deals are the same. You can say it's a 10 million or 50 million or $100 million deal, but what does that mean? How much of it is cash at close? How much of it is in a note? What's the interest rate? What's the security on that note? Do you have an earnout? Is some of that tied to future performance that you, the seller, might not have any control over? All those things factor in. Are you trading your stock for stock in another company? How liquid is that? Can you get out of that position? So not all deals, not all offers are going to be the same. And so you have to ask yourself, is this person trying to buy the deal, or can they close this deal that they're proposing, and do they plan to go through with it as written, or do we think they're playing some sort of game?
Yeah. And we've seen both sides, by the way. I always think back to the old Saturday Night Live, Father Guido Sarducci, where he's talking about visiting Rome, and he had a copy of the bill of the last brunch instead of the Last Supper. And, he said the seller, he wanted like 75 drachma, but I Presbyterianed him down to 50. So, and this is what we call when we've seen this, there are some cases where we've had it happen to, portfolio companies. We get what I would say is a Godfather offer, and it's legitimate. Like that competitor or that PE firm has to own this asset. They want this asset. And so they want to clear the market. They want to make sure that, like, let's not mess around. We're going to give you a really good offer because we want to go under exclusivity. We don't want to be in a bidding war with somebody else. Sometimes that's true. There's also some guys that, throw up a high price out there to get you into a due diligence process, knowing that they can start, a death from 1,000 cuts, carving you down to a lower price.
Right. And that's absolutely true. The way that I call that is when you're dealing with a buyer, and actually when you're buying a company, the buyer should ask themselves, is this a nice to have situation, a nice to have acquisition, or is this a must have? And you have to, and maybe it's a little bit squishy to try and determine that, but you should be able to determine that. And if you're a buyer and you're looking at something and if we get it for the right price, it'd be nice to have, but it's not must have, that buyer can walk away. And the seller should realize that too. And so the seller might want more. Everybody wants more. There's nothing wrong with wanting more. You have to negotiate and agitate for yourself, of course. But if you make that determination, this is a nice to have situation for the buyer, not a must have, you will be limited in terms of what that buyer will be willing to offer or willing to do in terms of changing the offer, because they can walk away. That's always a choice. They don't have to do a deal. And if it's a nice to have situation, it is very easy for that buyer to walk away.
Yeah. And this, I've seen sometimes you can get a really good answer to that for if you're asking the buyer. Sometimes you can't. Like, for example, private equity firms, sometimes if you've just raised a new fund and you haven't been able to put the money to work, you may be more aggressive about going after a deal because you've got to get your money to work. So we got to get a deal under. So sometimes it's like, wow, that's a weird, they're not going to tell you that, but it's a weird, you can sort of figure it out by, hey, when did you raise the fund? How many investments in that fund? You can sort of figure it out. With strategics, it's usually relatively easy. If you ask them, it's like, look, why this asset? Why is it critical to you? And a lot of times they'll tell you, hey, look, your product will sell really well to my installed base. So I can see how this is just an add-on item. And it's perfect for us. Or, wow, your product is new and much better than it's revolutionary as competing with our product. And, we want to buy our way into that new market. I mean, you can usually figure that out if you spend the time looking at it, but it's important to do that.
It is. And there's not an exact science. You're absolutely right. There's not an exact science to it, but you should do all you can to ascertain what is their genuine level of interest. And the private equity firms, the challenge there, and this is not to criticize private equity. I've got a lot of friends in private equity, but if it's a portfolio company, the initial investment, okay, not an add-on, but they're going to use this as a platform. Of course, they're all portfolio companies. I meant to say platform. If it's going to be their first investment in a platform, are they really interested? Because it's easy to walk away. If the bidding gets too pricey or they see some sort of problem, it's easy to walk away. If that PE firm has an investment in XYZ industry and the company you're selling boy, that would be a real good fit. And they know that, the buyers know that, boy, we are competing with them all the time. They've made overtures to me before, and I do something they can't. I plug a hole in their product offering. When you get that sort of situation, then you know that you've got, I call that a strong hand. And I always liken negotiating to playing poker. And I always encourage people who want to do this kind of work to play cards with your friends for a little bit of money. It doesn't have to be big stakes. It should be enough that when you lose, it stings a bit, because you have to learn how to read the hand of the table. And you have to not just look at your cards, but you have to look at what everybody else is doing. And the biggest lesson in this business, if you want to be a good negotiator, is understanding when you have a weak hand and a strong hand. And the strong hand actually causes more problems, because people with a strong hand, think about a card game, people don't know what they're doing. Oh, I was just dealt 4 aces. What do? They bet heavy. They bet crazy. And what does that do? That's a signal to everybody else they've got something. Everybody else folds. Congratulations, you just bought the ante. You had a strong hand. You misplayed a strong hand. And if you have a weak hand, you have to figure out, well, how can I extricate myself from this with as little damage as possible? So that is the absolute most important thing about negotiating. And again, when you have a strong hand, do not overplay that strong hand. You have to learn how to play that properly. Otherwise, you'll end up with little or nothing.
So right out there, you mentioned something earlier that takes us right to bullet number 2. How is the buyer financing the deal? So that was kind of one of those, sort of a sub to, is it too good to be true? So let's talk about that for a minute, because I think most founders, most sellers don't actually, understand the dynamics here of, what do you mean? How are they financing the deal?
Sure. Yeah. They quite often think this is similar to selling that old sofa in your basement. You used to put an ad in the paper. Now it's maybe something online, and $100 are best offered. You don't care what you get for the sofa. You just want someone to show up. You'll give it to someone because you just need it out of the basement. You need someone to show up with a buddy in a pickup truck, and it's yours. $50, good enough. I'll take it. Right. They think it's simple and straightforward like that. And of course it's not, because it's a much more complicated type of venture. The dollars are going to be substantially more than just selling some old sofa or something like that. And quite often the deal is not going to be all cash at close. You're going to have a holdback. You're going to have promises that the seller makes to the buyer. The buyer's going to have some sort of ability, some sort of indemnification, some sort of ability to go after the seller by usually putting some money in escrow, or maybe having an insurance product for rep and warranty insurance to be able to get some money back if something was misrepresented by the seller. And it's just not cash at close. Quite often you'll see structure. What structure? We want a note. Okay, so we'll pay $10 million for the business. We'll give you $5 million cash at close. We'll give you a note worth $3 million, and we'll put together an earnout. And for the next X number of years, the company has to earn a certain amount of money, and then you can earn up to another $2 million or whatever the case might be. So you have to look at that, because not all offers are the same. Also, if they're financing it, do they have the money? So if it's a big private equity firm coming to you, and you've just seen that they've raised hundreds of millions of dollars. They've got all kinds of capital under management. You can see their list of portfolio companies. They regularly are able to get transactions done. You're going to feel pretty good about them, that they're going to have the money. If it's somebody who's an unfunded sponsor, maybe a guy or a couple people looking to buy a company, do they have the money? Maybe they have a little bit of money, but the rest of the financing, they've got some friends and family and other people they know in business who said they will be investors, but they have to go back to those people and say, here's the company, here's what we're paying, here's how we've structured it, and here's how much more money we need from you. Can they get some money from the bank? Most buyers are going to put some leverage on a business to help finance that. So you have to look at all of those things. How viable is that transaction? And we had a deal. How's the buyer financing the deal? I had a deal years ago, and we had numerous offers for a company in the low to mid 20s, 24 million, 22 cash at close, and a $2 million note, stuff like that. And then we had one outlier that the total deal value was, I think, 33 million. And well, that sounds better, right? Who wouldn't want 32 million versus 24, right? But they're not all the same, because when you looked at that 33, it was $2 million cash at close, $27 million note, and some stock in basically a penny stock type of company that traded at maybe, 1,000 shares a day. I mean, it was just no liquidity in that. And the owner wanted to go for the bigger dollar deal, even though, how are they financing it? they're financing it with a lot of error right now. And it turned out to be a terrible situation. They constantly, the seller constantly got retraded. The buyer couldn't make the interest payments, not surprising, on that size of a note. So take more stock. So now they're just debasing the company even more by issuing stock. So it was just a debacle. I did not want them to do that. Their lawyer did not want them to do that. They had other viable offers. They should have taken the substantially all cash at close. Might have been a smaller amount. They would have walked away with a lot more money. And that's why you want to understand how the buyer is putting the deal together. Where is the buyer getting the money or claiming to get the money?
Yeah, and you always ask, I mean, look, you mentioned at the start of it, a private equity firm that looks like they have plenty of cash. They just raised a fund. They can do it, no problem. There's still the issue of, most private equity firms have a percent of fund they can invest in any one company, right? So, they may be in a situation where they're paying 70 million for your company, but the most they can put in themselves is 50 million bucks, which may mean they have to go to co-investors, or they're looking for a certain amount of debt that they may not be able to get. So even though they have a big wallet, you still have to. It's still worth asking the question. How are you financing this? And and that's the one I think a lot of people don't do.
Yeah, absolutely. You want to dig into the nitty gritty. Where are you getting the money? How are you financing this? What are the status of those conversations? And it's never going to be 100% certain. Things go sideways. Look, I sold a company years ago to a big strategic company, that was backed by a big private equity firm. And you would know that they were a big private equity firm because they told you this at every moment. They told you how much money they were raising and were successful.
No, this is a shock to me, but I don't know what you're talking about, right?
Yeah, we've raised hundreds billions of dollars. We got all this money, and so it was a difficult negotiation. Now we're ready to close. And on the eve of the closing, I was at home. I had my phone next to me. It was about 9:00 at night, and I'm about ready to breathe a sigh of relief. Okay, looks like we're getting this thing done. It's 9:00, 10:00 in New York. If we would have had a problem, I would have known. So now I'm happy we're going to get the deal done. My phone rings. I look. It's the CFO at the company. That's not a good sign. When the CFO calls you at 9:00 at night, 10:00 his time, not a good sign. And he says the buyer, we just heard from the lawyer, buyer doesn't have the money. What? And so, of course, I read them the riot act the next day. Bill, we're sorry. It was a paperwork snafu, totally our fault. Well, hey, you told me you had all this money. Well, it was a paperwork snafu. They forgot to check a box or something silly like that. We closed a week later. So in the grand scheme of things, not a big deal. But nonetheless, you have those heart attack moments. Wait a minute, you guys, all you talked about is your money. They did have the money. It was a paperwork thing, minor thing, but you don't know. You just don't know until... What I always tell people, the deal is not closed until the money changes hands. Specifically, the money shows up in my account. Then I know that when I get my piece for my work, then I know the deal is actually closed. Until then, it's not closed.
Yep, and that's certainly true. I mean, the deals come down to the final hour in a lot of cases.
Yeah.
So we talked a little bit about this, but let's dive into a little bit more detail. So pitfall 3 is how much cash is in the offer, and I think we sort of covered that, but it's worth highlighting. How much cash you're getting in your pocket versus how much is an earnout, how much is a note, what are the pieces of it?
Yeah, absolutely. And that you have to ask yourself, if you're a seller, what is important to you? Look, all things being equal, who wouldn't? Look, I'll give you $10 today or $10 a year from now. I'll take my $10 today, right? Who wouldn't, right? But it gets a little tricky when you say, well, I'll do this. I'll give you $10 right now today, or I'll give you $5 now and $10 in a year. So you get 15 total. Now, what's the better deal? You can't answer that. You have to look at a lot of other factors, what you want as a seller, how strong you think the buyer is. Do you think they're going to follow through? Because there isn't a right or wrong answer. You have to ask yourself that. Most people are going to want cash at close. I want to see as much cash at close, but maybe in a situation, I'll take the 5 now because that gets done what I need to get done, helps me accomplish what I want to accomplish, and everything else is gravy on top, and I'll get a nice home run in a year. Maybe that makes sense, but you want to look at the cash at close. And we can go back to that other transaction I talked about, 32 million in value, only 2 million was cash at close, and it was a complete debacle.
Yeah, and I think that's the difference between as we talked about what's the source, how are they financing the deal? Because even if the private equity firm's taking on debt for that deal, it's still cash in your pocket. This is more about how much you get in your pocket versus how much you have to wait on. And I think the thing that mostly surprises sellers is the financing of that is really coming out of the cash flow of the business. So
Yeah.
they're giving you $5 million today and $10 million for a year from now, or spread over 3 or 4 years.
Right.
The private equity firm, well, the buyer, they aren't basically just got money in the bank and they're just handing it to you later. It's generally going to be based on, the EBITDA of the business, or
Sure.
that's where the cash flow is coming from, and that's probably in the terms and conditions of your non-cash portion of this, that you've got to hit some certain numbers. And that's really one of the challenges for sellers in those cases, is they no longer control the business. And so, the buyer is, saying, look, we're going to base it on EBITDA, and they throw a bunch of extra costs on the business, in an attempt to grow or bring in a product line. That's going to affect their ability to pay your proceeds, basically.
It is. Yeah. And the earnout has become, it's kind of a Frankenstein's monster in my view, where typically, or at least theoretically, the earnout was supposed to do what? Okay, we're trying to work out a deal. Here we are. We're late summer right now when we're recording this, and I'm going to buy your company, and you're telling me I'm going to do $5 million in EBITDA, Bill, and I'm looking at your numbers, and I say, no, I think you're going to do 4. So we have a disagreement. Well, how do we bridge that? Well, we're just a few months away from the end of the year. I'll tell you what, we'll close right now. I'll base the deal on the $4 million price, and then we'll do an earnout. Okay, because you think you're going to do more. Well, I will pay more based on what the final year-end numbers are. So if you hit the 5, I will pay a price, the valuation, or the multiple rather, that we agreed to. I'll base that off of the 5 million. And if you don't hit the 5, if it comes in at 4 or 4.2 or 3.9, then I'm going to pay you based on what the actual numbers are. And so maybe that makes sense, because we're talking about just a few months. You're going to earn it out. It's just a few months. But what happens is it becomes a financing tool, and now it's going to be a multi-year thing. And everybody now thinks that an earnout is akin to cash at close or stock, or even a seller's note. And, you can't stop it. It's going to happen, but you want to minimize that as much as possible.
Yes, but specifically in the cases where you no longer control the business, and that's typically when you're talking about buyout versus a venture investment, a minority investment in the business. You're still running it. You can still control it. This is a case where you've given up control of the business, and so you're along for the ride, and you no longer can make the decisions that may be against your best interest, basically.
Absolutely. Yeah. You just can't look at the deal value. I mean, that's a big part of it too, but you should look at the cash at close and then make some determinations. Okay, this deal here is a smaller value. Deal A is a smaller value than deal B. But deal A, I've got more cash at close and less structure. Then you have to make those determinations. And I'm not saying you have to take one or the other. You have to make those determinations. But maybe a smaller deal that has more cash, maybe that makes more sense for you. Maybe you should go with that. Maybe that deal that has a higher value, but there's more risk, maybe you're willing to take that risk. Again, there's no right or wrong. Yeah, every situation is different. Every seller is going to be different. But you want to look at that. One of the key things, of course, is how much cash you're getting, because that to me, not the only thing, but that is one of the most important things in terms of helping make that determination.
And certainly, if you're getting less cash at close, there's got to be some upside if you're on an earnout. It can't be just, the difference between a deal that's all cash and a deal that's an earnout. They're just paying you over time. No, there's got to be some upside for you. Why would you take that risk without some upside? Right?
Yeah. Why would I take what today and put it all in the come line, or a substantial amount of that, and if everything goes perfect, I'm going to get where I'm at right now? That just doesn't make any sense. I mean, there should be a premium for that. If you're taking that risk, you should be able to get some sort of premium for taking that risk. And sellers, the same thing. You have to think about the buyer. I have buy-side clients. I'm sorry, buyers have to think about the seller when you're putting that together. That the seller has options. Is this deal just good for you, Mr. Buyer? There's somebody else on the other side of the trade. And so you have to think about, would you take the deal that you're offering? Because if it's completely one-sided, completely biased on your side, that's great for you. But would you take that if somebody offered it? What would you think if somebody offered that same deal? You might be upset and insulted by that kind of an offer.
I mean, sometimes it is what it is. Sometimes it's, you've got a buyer who has to have your asset, and you are getting incredible terms, and there are some cases where, as you may have sent out 200 deal books, and, you got one guy writing a letter of intent. You don't have a strong hand from a negotiation standpoint. So in those cases where it's like, look, we went out to the market, we talked to everybody who might be a great interest in your business, and there just isn't a whole lot of interest.
Yeah. Well, and that comes up all the time. And what business owners have to understand, in fact, I've got some early ideas to do a presentation on this. Not all EBITDA is created the same.
Sure.
Okay, because they'll look at that and they think, well, how come I'm not getting this full value? I've got X number EBITDA. Well, they look at everything else. What's going on with the business? Have you had ups and downs? Are you relying on a small number of vendors? Do you have a massive concentration? Do you have a long sales cycle? All these things factor into what somebody might be willing to pay for a business. And then it goes back to something I said earlier. The buyer, if you've got that one buyer, is it a must-have or is it a nice-to-have situation? And if it's a nice to have situation, then you have to tread carefully. You don't have much in terms of ability to negotiate because that person will just walk away. Nobody has, and I've said this many times to many clients and many other people, I call it magic words. Nobody has magic words. And if you're hiring somebody like an investment banker and you get the sense that they are trying to say they have some sort of otherworldly ability to get people to pay more, that they can whisper their magic words. Nobody has that. If somebody bids something and you don't have competition, you don't have a strong hand, and you look at that, nobody has ability to say, whisper the magic words and get that person to up the price. You can go back and say, look, this doesn't get it done. We would like to see, you can propose something else. Nothing wrong with that. Maybe you get move the needle a little bit, but you quite often, if it's a nice to have, not a must have, that buyer is probably not going to be that interested in changing the price, the terms, and so forth. And you don't have any other options. So you are really limited in your ability to negotiate. And it's a tough, bitter pill sometimes to swallow, but I think we have to realize that, again, it's reading your hand and it's reading the hand at the other players at the table. If there's only one other player and they just might fold and walk away and you get the ante back instead of being able to win the pot, then you've got to play accordingly. Be careful, tread carefully.
Yeah, and before we I want to talk about escrow here, which is point number 4. But dovetailing into that, Bill, that's one of the timing issues is really a challenge, which we find a lot of times with founders, business owners. The market changes, and maybe 2 years ago the market was amazing. They're like, yeah, I'm gonna ride this for a couple more years, and by the time they decide to sell, it's like, look, the market conditions have changed. They're always disappointed. Like, well, I talked to my investment banker 2 years ago, and he said my business was worth $40 million. I'm like, yeah, because multiples were at 10 times EBITDA for your market, but they're not at 10 times. I don't know what to tell you. They're at 6 times now.
Yeah, I know that's a challenge. It reminds me of a friend in college, and he would this is back in the day before computers were everywhere. So he had these things, they're called books. They have paper in them. You might have heard about them. Maybe the younger people, this is going to be shocking. You can write this down. They're called books. They're made out of paper. And so he would go through these finance books, and he would look up all the stock charts for all these stocks, and he would fantasize about buying stock on that chart at the absolute lowest point and then selling at the absolute highest point. And that's all he would think about. And I would tell him that would be great if you could do that, but to time the market, no one, fine. It was at 10 and it went to 80. You're never going to be able to time that. Nobody knows. You bought it at 25 and sold at 40. Okay. You made money on that trade. You should be happy with that. And so it's the same thing with I think the buyers, the sellers. A lot of times they are looking to time the market. They look at certain numbers. They'll look at something they see in the Wall Street Journal. They want to get that same number, and they don't understand all EBITDA is not the same. Okay. The ability to get a valuation is based on numerous factors. The skill of the investment banker, sure, that's part of it. But the most fundamental aspect of what a company is worth is the strength of the underlying asset itself. Okay, and you have to look at all those factors, what's going on, the growth and the EBITDA margins and all that kind of stuff, any concentrations. Tenor of the times, yeah, that can impact. So we've had, I think, a very destructive period with these very low interest rates. Why was that destructive? Talk to anybody on a fixed income and what they were earning. It was terrible. And so business owners just weren't going to market because they would just keep their capital in their business. That put further upward pressure on valuations, on the multiples that were being paid. And I told business owners for years, at some point this is going to change. And of course, this has changed in the last couple of years. We've been increasing interest rates, maybe too fast, but we've had a lot of inflation. We've had inflation in M&A. We've seen inflation elsewhere because of this cheap money that we've had for a long time. And what I've told business owners, what I was fearful of, and it sounds like you're getting a lot of the same thing, is that they heard a couple years ago that they could get X for the business. The multiples were much bigger. And now guess what? Money costs more money.
Right.
That's putting downward pressure on price. And so the multiples are coming down. The good news is for sellers, you can get a far better return on a fixed income product today than you could a few years ago.
Oh, for sure.
Okay. And so you want to keep that in mind. The ideal thing would have been someone to sell a few years ago, get more money, and now be able to put it safely into some instruments that pay better. Because look, if you're retirement age, if you're in your 70s or 80s, I don't think you should be going long unless you've got money to burn. You need to put money where it's safe. I get safety on my principal and I get a good return on top of that.
Sure.
I don't want to risk my principal. I'm not going to go long in the stock market because most of those growth stocks, they're a lot of risk and they're not paying any income. I need to get something where I can get a decent return on it. So you can get a better return today. Maybe the multiples are down, but that's the way it goes.
Yeah. And I think that's the, last thing before we dive into escrow here, because I think this is part and parcel of what we talked about on the risk side. I think that people miss the key element here, which is cheap dollars allows private equity firms to use less of their own cash and more debt to buy these businesses. The debt service is lower. You're juicing your returns. If I have to write you a $50 million check out of my own pocket versus, a $20 million check and $30 million of debt, I got a much nicer return because I'm taking very little money from my investors. I'm, taking it at a bank at a low rate. And if the company is growing, it's profitable at a higher rate than that interest rate, I'm making money just in the arbitrage. We're not in that market at this point. And I think that's, all the, it's a connected world. So all those prices come down and it's, and that's difficult in this market when you see, sellers like, hey, they decide to hold out for one more, see if they could time it, or they may not just been mentally ready to sell the business. And they're like, now I want to sell it. And sorry,
what I always tell business owners to that extent, this timing the market, the macro can impact a company, of course, but the most important thing in M&A, selling a business, is the micro. What is going on at your company? Because a strong company growing, strong profit margin, strong EBITDA margin, no customer concentration, no issues with vendors, a management team that is not planning to retire anytime soon. They're going to be there for a long time. It's just a really well-run business that doesn't need the owner, by the way. That makes it even more valuable. I don't care if it's a good economy or bad. If you have a growing company that checks all those boxes of a quote-unquote good company, that company will trade for a very good price, probably a premium, whether the economy is going great gangbusters or if the economy is bad. And the check there is a great economy, but a struggling company, a bad company. Revenues are dropping, it's losing money, or the profits are dropping. Management team is about ready to retire. Issues with suppliers, whatever it is, problems with the company. I don't care how good the economy is, that bad asset is going to struggle to find bidders. So focus on the company, the micro, control what you can control. A strong company will trade at a very good price in a good economy or bad economy.
It's true. For sure. That's true. I tell you, just from the private equity side, though, you're going by market multiples and you just can't, that even a great company, sure, you may pay a little bit of a premium, but if multiples went from, your public comps from 12 times EBITDA to 8 times EBITDA, as the private equity guy, you don't want to be the guy still paying 12 times EBITDA for a business, because the risk is too high.
Yeah. We're seeing that. I have a buy side client. We bid a few years ago on something. We bid 8.5 times on a 10 million EBITDA business. And this was a nice to have for my client. This was not a must have. Would have been a nice thing to pick up, but this was absolutely not critical to their future plans. So we bid accordingly, which was a pretty strong bid by any relative measurement. But I mean, the market was so frothy, a few years, it's still frothy now. I thought we would at least get to the second round, get to meet the management team, and then all bets are off at that time. Maybe we can woo them because my client is a really good client. The investment banker handling the sale told us to leave and don't come back. Kicked us out of the bar. Basically, we weren't even close. We didn't get invited to the second round. And then a couple of years later, I was talking to another private equity guy, and we were talking about that deal. And I said, "Yeah, we bid on that 8.5 times. We weren't even close." He said, "I bid 12 times." And I was not invited to come back to the next round.
Insane.
Okay.
Yeah.
So, and a private equity firm bought that. I won't say who, but a private equity firm bought it. I don't know the details, but I'm guessing, if 12 times doesn't get you into the second round, what did they pay? 15 times? Why? Because maybe they saw some strategic fit there. I certainly hope so. I hope it works out well for them. They have to put money to work, but they probably paid $150 million for a 10 million EBITDA business, more than my client, which is a strategic, because the PE firms have that much money. They've got to put that money to work. And so we've seen that recently, maybe that changes, where the PE firms quite often are stronger bidders than some of the strategics, probably because the strategics are in the nice to have, not the must have camp.
Yeah, I'll tell you the place where it's different, and I know we're not even at number 4 here, which is good. We've seen it. There are market conditions where strategics are much better buyers, right? They pay much more premiums, particularly if we're buying. If you're a Jeffrey Moore fan, and you believe in the crossing the chasm and his metaphor of like gorillas in some markets, and then a smaller number of chimps and a bunch of monkeys, right? There's usually like one big guy. If we're buying a platform company that's going to be one of the tier 2 or tier 3 players, and then we start bidding on the assets that we want to add to that, we often get outbid by the strategics because they can, and they know exactly what to do. They already got a sales force. They already know, like, they're just bigger. They can just channel this thing right through their existing channels and cream us, so they can afford to pay a higher price because it's basically a more valuable business to them. And in those cases, It is what it is,
Yeah, absolutely. Absolutely.
So let's talk about, related to how much cash is in the offer, escrow. So conditions for escrow. Let's talk about, for people who don't understand it, just a quick definition of escrow as it relates to this particular topic.
Yeah, a seller is going to make a lot of promises. They're called representations. They make representations to the buyer that the financials are accurate, that the inventory is sellable. The buyer's going to be doing their due diligence and checking all this stuff too. But nonetheless, the buyer is going to ask for a lot of promises that the customers are this, and they're active, and all these things. There's going to be a ton of promises. And what happens is, if the seller has breached a representation, right, has maybe somehow gotten through something that wasn't accurate, okay, the numbers aren't the numbers, or a customer is not as strong, isn't doing as much, whatever it is, it's a breach of a representation. The buyer has to have some sort of recourse. Wait a minute. Part of the reason we paid a certain price is because of all these promises that we understood. This is not what you told us. This promise here is not what you told us. That makes the company worth less. We should have paid less. And so typically in a transaction, you'll see some money put into an escrow account. Usually it's been about 10% of the proceeds. So a $50 million transaction, you might see $5 million, maybe a little more, maybe a little less, put into an escrow account. How long? 12 months, 15 months, 18 months, really depends on what is negotiated. And that money is there in case the buyer has a claim against the seller. Okay, so all of this gets hammered out in the purchase agreement. They might have a cap in a basket. So little de minimis things. Okay, unpaid invoice for $5,000 comes in. Well, the buyer maybe just says, we'll pay that, but they might tally that up. And if it gets to a certain point, gets to whatever that number is, 50,000, 100, 200,000, whatever has been agreed to, then that buyer can make a claim against escrow. But the idea is that little picky uni things, okay, a small invoice, a couple of those, we're not going to worry about that. It's relatively small, but if it piles up enough, we will make a claim against escrow. And so the sellers have to understand, well, how much is going into escrow? What are the promises? This is where your lawyer is very, very important to help you understand that and set that up correctly. What is the recourse that the buyer has? Okay, does the buyer just take the money, or does the buyer make a claim? And then the seller should be able to say, wait a minute, that's not true. The buyer's just trying to take some money, or they don't understand the situation. Let me explain. Let me resolve this situation. So you want to make sure that all of that is detailed in the purchase agreement. We're seeing a lot more of the representation and warranty insurance. So instead of putting that $5 million into escrow, maybe a smaller amount, maybe half a percentage is put in. So maybe a couple $100,000. The buyer and seller will agree to buy an insurance product. Sometimes the seller will say, I want to do rep and warranty insurance. The buyer needs to pay for it. It needs to be part of their offer to me. But it's a negotiation as well. Maybe both parties decide to split the cost of that. But how that works is the seller gets more money at close. So instead of tying up a chunk of money in an escrow account, that seller has that money. If the buyer has a claim, the buyer then contacts the insurance company who provided the insurance indemnification for that escrow amount.
Yeah, we're seeing much more. Yeah, we're seeing much more rep and warranty, than escrow. It gives the seller a lot more, I think, clarity on this. So then let's dive down to the next level here: stock or asset deal, because this is always a big one, which I think confuses people. Because you think private business, they think we don't have stock. It's okay. That's not the term. That's not what we're talking about here. Talk a little bit about little bit about the differences and why it's important.
Yeah, when you buy something, you're either going to buy the stock or the equity. If it's a LLC, you're going to buy the membership units. Basically the same thing, just a different term. Or you're going to buy certain assets, maybe assume certain liabilities. You can do either. Business owners who are selling should sit down with their tax people and have them crunch the numbers and understand the basis in the stock or the equity in the business, and also the basis on certain assets. If certain assets are sold and maybe some liabilities are, current liabilities are assumed, what is the basis on all of that? And then you have to look at how your company is structured. Now
by basis, you mean dollars. What are they worth?
Yeah. So in other words, if you bought $100,000 worth of stock and you sold it for 150, okay, you don't pay capital gains on 150,000. You pay capital gains on 50,000 because you had $100,000 in basis in that stock. So it's the same sort of situation with a company. The assets cost something. Okay, well, you're selling assets. You have $5 million worth of assets, and you sold the business for $7 million. That's a $2 million gain on those assets. Have your tax people sit down and do it. This has been a major problem sometimes trying to get accountants to do this. The business owner calls up and says, I'm thinking about doing a deal. And this is what the accountants do. And it drives me nuts. You accountants need to stop doing this. It drives me nuts. They do this. I call it the yeahs. Yeah. They always wave their hand. Yeah. Do a stock deal. You'll be fine. Well, maybe that's best. Maybe the buyer doesn't want to do a stock deal, right? Maybe an asset deal is better. I have a deal now where I got the yeahs from the accountant. A few years ago. It's been a long process. Do a stock deal. They didn't do the calculation. I finally got them to do a calculation. And guess what? An asset deal is better for the client for numerous reasons. There's a lot of assets in the business. It's being sold at less than asset value. So there's going to be a loss. And it's easier to report that on an asset sale. So that's a benefit to the seller if that goes through. But have them do the calculation. I don't need it down to the penny perfect, but you have to do this. And my experience is you have to ask the accountants, you have to tell them 3, 4, 5, 10 times to do this, because they wave the hand, they do the yeah thing. But at some point, they will sit down and put pen to paper and figure out how a purchase price is being allocated to the company that is being sold. And they will calculate if a business owner has a capital gain that they have to pay on that sale, or if there's a tax benefit because it's being sold for a loss. There is no reason why a capable accountant cannot sit down ahead of time and come up with an estimation. Again, it doesn't have to be down to the penny perfect, but I want to understand. Now, if the seller absolutely has to do a stock deal, maybe it's a C Corp, right? If you sell the stock in a C Corp, the money comes in for the stock. Now that money, it resides with the company. And then to pay that out to the owner, that money gets taxed again. So quite often the C Corp will get taxed at 2 levels. So in that situation, the seller might want to do an asset deal. Okay. Now, do an asset deal, do a stock. Well, you have to talk to your tax people. It gets very confusing in terms of this. The buyers quite often want to buy assets, right?
Well,
They don't
for
want
the
to buy
liability
stock.
purposes, for
Yeah,
sure, right?
and that is a bit of a misnomer. Because if you buy assets, and that's going to include the logo and the name and the website and the likeness and all the intangibles, and someone has a problem, they're not going to look at a corporate shell and sue that. Maybe they will, but they're going to look at, well, who owns the facility and the name and the logo and the website and has all the same people, just a different owner. You're going to get sued anyway, because anybody can sue anybody for any reason. So if you are,
for sure, but it's the game of the seller, right? When they, sometimes when they're going hard, a buyer, when the buyer's coming hard on an asset sale, it may be because they want to carve out, then you're looking really hard at the purchase and sale agreement to make sure you're not being handed a bag of something.
And this is why your tax people do not accept the yeahs. Have them do the work. Oh my God, they're going to have to do work. I do this because it is very frustrating. I've dealt with this on multiple occasions, and it happens every time. I get the yeahs, and they refuse to do the work. And then it comes back and it bites someone in the keister later on. If you're a seller, you absolutely have to do stock as the sale. You can't sell assets because maybe you're going to get taxed twice on something, or a higher rate, or whatever the factor is. If you absolutely have to do stock, make sure your tax people have done that calculation, maybe run a couple different scenarios, and then explain that to the buyers. We absolutely cannot do an asset deal unless you are willing to pay more to true up what you're paying to help cover the extra taxes that we're going to pay. We would be willing, I know it's a stock deal, we would be willing to provide extra stringent representations and warranties. We'll let the lawyers hammer that out. But if you can signal that ahead of time, that will help bridge that gap between whether it's stock or assets. But the biggest thing is have your tax people, I'm saying this again, hopefully this starts sinking in. Don't accept the yeahs. Have them do the actual calculation, because they will have to do the actual calculation at some point. I see no reason why they can't run a couple scenarios, make some assumptions ahead of a sale process, and at least come up with a very good ballpark idea of what is better, a stock or asset deal.
So just so I'm clear, because it's slightly confusing here, Bill, sorry.
It is.
You're saying that you should have the accountants do this in advance.
Yes. Absolutely. And if they refuse, you will have to ask them repeatedly, because here's what happens. They say, oh my God, this sounds like work. Now you have to understand, when people go to school, you know how people become accountants, they go to school, they ask somebody, what kind of job can I get where I don't have to talk to people? Accounting. Okay, I'll be an accountant. So now all of a sudden you're asking your accountant to do work. And I'm saying this, and I'll be happy to tell this to, I've had this heated discussion with accountants, because they freaking refuse to do the work. They do the yeah. Bill, yeah. They need to do this. I don't want the yes. I don't want the wave of the hand. I want someone to spend a little time, look at the balance sheet. We can make a couple assumptions of how a deal might look. And I want you to do the calculation, if it's a stock deal as if it's an asset deal. And I can help you come up with some scenarios, but I want the accountant to do that. And it drives me crazy, as you can tell. They absolutely refuse to do it. And quite often that yeah is completely wrong what reality is. And so if you're a seller, don't accept the yes. This is now what, the fifth or sixth time I'm saying that? Do not accept it.
I've sort of lost count.
Run the numbers, because it will end up costing you, seller, a lot of money if you don't get that figured out ahead of going to market, because you want to make sure your investment banker knows what the deal is and what we have to do. And we need to explain that ahead of time, not after the fact.
Yeah, no, that's the key, is the ahead of time. And that dovetails into our next point here, which is, working capital. How is that settled post-closing? And again, I think most people, a lot of founders don't think of working capital as it's sort of, they go to their bank account and I've got money in the bank, I'm good. If I have more money than I had last year, I'm better. But they don't think about working capital. So let's talk about that for a second. This becomes the biggest pain point between sellers who have inexperienced advisors trying to negotiate through. It's like the family accountant or something that isn't used to doing this. It becomes a very difficult conversation for us, particularly in cases where companies have a lot of, have a large working capital. They have a lot of inventory, or, software companies, your working capital is often relatively small, but anything that has real assets, like manufacturing.
Yeah, the idea that you're buying a company and it has a certain value. Why? Because it has certain assets. It's being run in a certain way. It has sales. That has all the other things that you're looking for, and it has a certain value. So if you are selling a business and you don't have some sort of mechanism to make sure that that working capital is delivered correctly at the sale, what will happen is you might give a perverse incentive for a seller to do what? The cash belongs to the seller. These deals are typically debt-free, cash-free. So any cash belongs to the seller. Any funded debt, bank debt, things like that, that needs to get paid off. And whatever is left belongs to the seller. Well, shoot, cash belongs to me. I'm going to call up all the people in my receivables right now, and I'm going to start cutting deals. I've got $1 million in receivables. Well, I'll collect that for 50 cents on the dollar. I'll get $500,000 and have zero. That's better than turning over $1 million in receivables. I'll take $500,000 or whatever. Inventory. Oh, I've got $2 million worth of inventory. Well, I'm going to sell that off for pennies on the dollar and collect as much money as I can. And the payables, I normally have $500,000 in payables. Well, I'm just not going to pay my bills. I'm going to run that up to $1.5 million. So a buyer at close is thinking, and I've lost track of the numbers, that I'm going to have $1 million in receivables and $2 million in inventory. That's $3 million, and $500,000 in payables. So that's $2.5 million in inventory. That's the typical calculation. It's going to be inventory, receivables minus AP, accounts payable. You might have some prepaid expenses, some other things, but the main thing. Accounts receivable plus inventory minus accounts payable. And if that amount is supposed to be, say, $2.5 million, and you show up to closing and you have $1 million in that calculation, that's $1.5 million less. The buyer's going to say, wait a minute, I'm expecting to have an asset, this working capital. Here's how we agreed we would calculate it. I'm supposed to have $2.5 million. I see $1 million. So what happens is I'm going to lower the price by $1.5 million. And the idea is it's to avoid having some sort of perverse incentive to do things like that. The working capital should be set at an amount that is fair to both sides. It should not be a pickup for the buyer or seller. And this is something that will bite people in the keister if they hire somebody who is not experienced. If that working capital target is set incorrectly, too high, for example, so the business is being run in normal course, it is being run fine, but that working capital amount was set too high. So if the target should have been $2.5 million, but it was set at $3 million because the advisor wasn't paying attention, the lawyer wasn't paying attention, guess what? That's going to cost the seller $500,000 at closing because that was not negotiated appropriately. And this is one thing that drives me nuts. People always want to get a cut rate deal. Well, you might find an advisor willing to take a small fee, but you have to ask yourself, what are you leaving on the table? And little things like that, the working capital, setting the working capital amount correctly. Is that going to be something that costs you a couple $100,000? Great. You save $200,000 on a fee. It just costs you $300,000. It actually costs you money. That's one of those boring things. So when you get to the closing, you will bring an estimated balance sheet. The seller brings an estimated balance sheet, and all those numbers are looked up, and we make the calculation. And then usually 30 days or 60 days after the close, the actual balance sheet as of the closing date is produced, because sometimes you need a few days or a week or two to close out a month or a period. And then you true that up at that point. So there might be some adjustments up or down. And that's why quite often you'll have some money in escrow. So maybe a little bit of escrow money is paid to the seller. Maybe a little bit more comes to the buyer. So there's a true up. If it's done correctly, that true up should not be a substantial amount of money. It should be a relatively modest amount of money, especially compared to the total transaction value.
Yeah, and I think we've found for sure if you've got found is this is often not covered in the letter of intent, right? So you're not getting to the details of this until you're doing your financial due diligence, right? So you're doing quality of earnings, and this is when it becomes very stressful. If you don't have a good advisor for the seller, this becomes this hugely. They just don't understand these calculations, and this becomes a huge issue.
it becomes a huge issue. And I'll tell you something else that will bite people on the keister. We had a deal years ago, and the company was a distribution company, and they ran it very, very well, very lean, and they had just in time or pretty close to just in time inventory. So even though the revenue was increasing, profits were increasing, the profit margin was increasing because it was a really well run business. The inventory was coming down. And so going out into the future, that inventory, that working capital amount, in other words, was going to continue to decrease. So it was very much an anomaly in these businesses, growing business, and yet the working capital was decreasing because they ran a very efficient ship. And so the buyer, their first stab at it was, let's look at 18-month average. And I said, that's just not going to be fair to my client, because now there was no pounding the table. There's no line in the sand, take it or leave it. Let's talk about this. Let me explain this to you. That's not right for my client, because you're getting a business that's being run very well. Let me explain why. And so what we did is, instead of an 18-month average, we did, I can't remember, it's either 6 months or 9 months average working capital. And by doing that, that saved my client, I think it was $200,000 or $300,000. So the formula that the buyer had was not wrong, because that's typically what's done, 12 months or 18 months, something like that, taking an average. But because of what was going on in the business and how they were running it, we knew that, we were able to communicate that. So again, a weaker, less experienced advisor might not have done that, might have set the working capital based on 12 months, and that might have cost, instead of 6 months, that might have cost the seller $100,000, $200,000, something like that.
And so if you're listening, as you tie this stuff back, right, this goes right back to, hey, conditions of escrow, right? Like working capital, final adjustments. Because again, the numbers move around a little bit. So it may take 60, 90 days to figure it out. If you're not covering this in escrow, in your escrow agreement, basically, you could run into problems for sure.
That's correct. That's correct. Yeah.
So part of that, we're moving from the working capital to, businesses that have inventory. And this becomes a big one. So, is the inventory saleable, and for how much, right? This becomes, in any kind of manufacturing or distribution business where you've got a decent amount of inventory, this can be a problem. We're software company buyers. So, inventory for us is literally nothing, not even a thumb drive at this point.
Well, you realize you've just confused all the young people who are just, they all want to be influencers this day, or techie people, software engineers. They don't know what inventory is. And so that they're probably looking up this word inventory, and God forbid things like WIP, work in process. Okay. So in the olden days, we made things, we made products, and they were made from raw materials, from metal or glass or wood or rubber, or plastic or soybeans or sand or whatever. And all that inventory has to be accounted. And so that is a big part of the working capital, as we have talked about. It's an asset. So if you've got inventory that says $5 million worth of inventory, first of all, do you really have $5 million worth of inventory? Depending on the type of inventory, the product, things sometimes grow legs and they walk away. I don't know if you've ever seen that before in a facility, especially if you have finished products as your inventory that are, I don't think it's shrinkage. I do think that these things just grow legs and they walk out of the warehouse on their own. It's just really weird. I'm sure people aren't stealing things or losing things. That doesn't go on. So you have to understand, do you have any shrinkage because of that? If it's a consumer product, if it's something easy that easily walks away, is it all there? So you want to count that. If it's a big industrial type thing, big, huge, steel beams and big, heavy things, well, people aren't going to steal that. So you're probably not having that sort of an issue. But is the inventory all sellable? Is it all good? Do you have any shrinkage? If you're a produce distributor, well, a lot of stuff is going to go bad. Just produce doesn't last forever. So is all that produce, is it all good, or has some of that spoiled and gone bad? Or if you're a clothing distributor, is it still all in style, or are you trying to sell, suits from 1980 that maybe are not quite the style that we want anymore, the fabrics that we want anymore? So all those things go into effect, and you want to make sure that all that inventory, the buyer wants to make sure that all that inventory is sellable. It's in good condition. It's not slow moving. It's not damaged. It's not obsolete. And the sellers need to do that. Now, if a seller doesn't do that, and we've had issues before, probably a lot of people have been through a sale process, know this. Okay, we've got $2 million worth of inventory. And the buyer says, well, you've got $500,000 there that's slow moving, it's obsolete, it's damaged, whatever. We can't sell that. You need to write that off. And where this can bite the owner in the rear end, and that hurts when that happens, is they say, well, okay, fine, you've reduced my balance sheet by $500,000. Big deal. No, 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 no. If your inventory is being reduced by $500,000 or whatever the amount is, that is going to reduce your earnings for that same period. So if you have a 5 multiple on a deal, that's not a $500,000 reduction in price. That could be a $2.5 million reduction in price. And that is a multiplying effect. And that's why that inventory is such an important thing that buyers or sellers rather need to make sure that all the inventory is usable, in good shape. It's not damaged. It's not obsolete. It's all sellable.
Yeah, and this could get super complicated. I mean, I'll give you 2 cases. One is, scrap percentage has had a history of going up at this particular manufacturer, so they were devaluing the raw materials because their manufacturing process on some new products just wasn't as efficient. So it wasn't what they used to make with the same raw material. The new thing, they couldn't make it at the same efficiency level, and so that caused a problem with the raw materials. The other case we saw, which was really complicated. This was a large public company that I was doing work for, but they had such sophisticated machinery in their plant that they had $45 million worth of parts, on hand for repairs to their existing machinery. And that was a very complex during a sale process, figuring out, is that $45 million worth of parts worth $45 million, right? And that was just literally, that was their spare parts inventory for their machines that manufactured their product. This wasn't the raw materials for the stuff they made. I mean, it was just sophisticated machinery, and they had to keep the parts in stock. And so trying to, get your auditors, how do you random sample that with your A's, B's, and C's in inventory, sort of figure out. Now, they had a good process for valuing inventory. And so, it turned out not to be a super difficult process, but, for a buyer, that was a very large number that they were looking at that they weren't used to.
Yeah. See, this is why auditors are such unhappy people, because they're accountants who have to sometimes talk to other people, and then they really lousy jobs. You might have heard about this. I remember years ago in northern Indiana, just outside of Chicago, where we have these big refineries. These big tanks are filled with oil and fuel and all the stuff that's been refined. I can't remember the company and exactly when this happened, but the company was committing fraud. And what they did is they filled up these huge tanks with water, and they put just a little bit of oil on top. Oil, of course, goes to the top. So the auditors go up there, they open up the tank. Yeah, that's filled up with oil. It was, 98% water, 2% oil. Well, that's a value of the asset. So there was fraud. So these poor auditors on New Year's Eve, the young guys, they have to go to these big, huge tanks. They have to climb up them, and they have these long poles, and they have to put the pole all the way to the bottom and ensure that oil is actually at the bottom. This is why auditors are such miserable people, because when they're 23 years old, instead of going out with their friends on New Year's Eve, they're freezing their keisters off in northern Indiana. Yeah, it's terrible. It's an awful job.
It builds character. Look, I was an accounting applied statistics undergraduate major, many years ago, and
you have a personality too.
The Touche Ross guy said, "Hey, we'll make you an offer." Back when Touche Ross was
Touche Ross. Wow.
And but the guy said, "I really wouldn't take the offer." He says, "You got like a smart mouth. This is probably not like a job that you're going to want." And he was definitely correct. All right.
Well, if you have a personality, you get into accounting, you can take over the whole firm in no time, because everybody's just quiet. The guys that wear the loud clothes, the fast talkers, can get out there and play golf and hobnob and do all that kind of stuff. They end up running the firm. It's easy to stand out. So if you have a personality, you can get into accounting, and
I'm going to make sure
within about a week or two, you can take over. Yeah.
I'm going to make sure I put Bill's contact information up bright and center on this podcast, so that all the hate mail from the accountants, that was Bill. I did not say that. All right. So as we kind of wind down, so the final 3 here. Long-term debt. And again, this goes right back into all the other cash proceeds. So let's talk about, who pays off long-term debt. So define long-term debt in these businesses, meaning what was there before, what gets added to it.
That could be a bank line. That could be somebody who loaned money to the business. Anything that's long-term, that's going to be not on the current liabilities in the business. That needs to be paid off. And some of the current liabilities might need to be paid off. We'll talk about that in a second. But the long-term debt is going to have to be paid off. So if a business borrows, say, $2 million and it's paying that off over some period of time, at the sale, the buyer is not going to assume that $2 million. Okay, we'll pay $20 million for the business and you need to pay off that $2 million. Now, maybe the buyer will assume that. Well, guess what? If that happens, they're going to lower the price to 18. And I've had this discussion with sellers and they think they're being ripped off. No, you're going to have to pay off that 2 million. So you got 20 million. Let's keep the number simple. You got the 20 million at close. You're going to have to pay off the 2 million. You're going to walk with 18 before all the other expenses. And well, that's not right. Well, if you don't do the transaction, you just hold on to the company, you will have to pay off the $2 million at some point. That is not the responsibility of somebody else. It's the same thing if you buy a house, right? The mortgage on by the previous owner, that's not your responsibility, right? You're buying a house for $500,000. The previous owner owes $200,000, right? You write a check for $500, right? And what happens at close? The bank gets their $200 back, and the person gets their $300,000 in equity. You're not going to pay $500,000 for that house and assume the $200,000 that is still owed by the previous person. So you need to think about it as if it's a mortgage. So all that long-term debt needs to get paid off. Maybe some of the liabilities will get paid off. I mean, will be assumed by buyer. Maybe some of the liabilities will be assumed by the buyer. Those are going to be the current liabilities. They're not going to be by the electric bill, the light bill. You're not going to assume when you buy a house, well, the previous owner hasn't paid the light bill for 6 months. Well, that's the problem of the previous owner. You're not going to pay that bill. You're the new owner. And it's the same thing. You're not going to pay those long-term debts of the business. When you buy the business, if you're the buyer, you want to make sure that all of those debts are paid off. So you're getting the business unencumbered by creditors that say, wait a minute, I'm still owed, I sent an invoice in and I never got paid, or he hasn't paid the electric bill, or, the bank loaned him $1 million. I haven't been paid off. All of that debt needs to be paid off at closing, because that new owner is not going to want to be left holding the bag with creditors saying, hey, I'm owed a bunch of money here because this person didn't pay off the loan.
Yeah. So this is as we dig through the final bit of this chapter. The part that was interesting to me was most of this, if you just read this chapter, as a seller, you're not going to be surprised by these things. The problems that we run into that we've seen with businesses when these are net new topics for the founder, because they knew their industry. The myth of the 17-year-old kid that starts a company in their garage and is a billionaire is basically a myth. Most business founders are in their 40s. They often come from the industry. They said, I could do a better job than these guys I've been working for. And, they build up this business over years, and they're really focused on making the stuff, selling the stuff. And if they got money in their bank account, they're good. The problem now comes when it comes time to sell. These are all oftentimes net new topics. And, if you look at just this list we've gone through so far, it's like death of 1,000 cuts. Like every time the founder turns around, and it's really hard for us as private equity buyers or even a strategic. Look, I get it. This is what we do every day. So these are very familiar to us, but on the other side of the table, the seller's thinks we're sort of used car salesmaning them for some reason, right? That these are, because they never heard of it before. They never focused on it. So the challenge for us is often the uneducated seller, is a problem, because, if we're the first guys in, it's like, oh man, it seems like every time we turn around, there's another issue that these guys say, oh, these private equity guys, they're driving us crazy with this. The reality is this is just basic parts of buying or selling a business that you may not have paid attention to, right?
Yeah. It's a learning curve for the sellers, because they've probably never gone through it before. Some have, some have multiple exits, but most cases, this transaction is going to be the biggest transaction of somebody's life.
Yes.
And it's probably the only time they will go through it. There's exceptions, of course, but it's probably the only time they will go through this. So it's all new. It's all a complete learning curve. The nomenclature, the steps, all the little minutia we're talking about, whether it's paying off debt and adjusting the working capital and setting the right target for working capital, all of that stuff they don't think about. And yet we do. when a buyer of businesses looks at a business, like I said, we rarely get the cash flow statement. That's the redheaded stepchild in the accounting world. That's the first thing I want to see. But I'll go over the balance sheet. I'll look at the balance sheet sometimes before I look at the profit and loss statement, because the profit and loss statement is just for tax purposes. It might not be completely indicative of what is really going on at the business. And I want to understand how the business is being run. And I'll look at, like most people, what are the current assets compared to current liabilities? Are they upside down or are they in good shape? Sometimes that can tell you if the business is being run correctly or if there are potential problems in the business.
Yeah, and that's you hit the nail on the head. It's like if you start this process as a seller sooner, just educating yourself, none of this comes as a surprise. It makes the whole process a lot easier. These are the two, I would say, the two things that we run into that are related is not understanding this stuff before the cycle starts. And I totally get, but we live in an era now where you can find it out. 20, 30 years ago, pre-internet stuff, a lot of this was opaque. How do you get this information? Now it's pretty simple to get this information, right? In fact, I think there's a book out called Mergers and Acquisitions for Dummies that does talk about it. You might be familiar with that book, Bill.
Yeah, look, right here. There's right there. Get the purple, and there's a poster back there too that I had to pay for.
So that's
absolutely
one.
Right.
That's one.
Absolutely.
And two is inexperienced service providers on the seller side. So you're using the family lawyer who's done your will, done your property taxes, but isn't familiar with selling a company. Same thing with your accountants, may not be familiar with doing it.
It can be penny wise, pound foolish, and the lawyer might be a very capable lawyer and has done a good job with contracts and helping you adopt that kid, and then got the kid out of the DUI when the kid becomes, because all kids turn into troublemakers at some.
This got dark really fast.
Yeah. Well, this is why the kid is going to run the business. I have to sell it because the kid is a troublemaker. And so that lawyer might be doing capable work, but when you sell a business, you want to have the experience of actually having done transactions, so you understand the purchase agreement, every paragraph, not why it's there. You don't want to have to explain to the lawyer why this particular paragraph is there or why this particular clause is there. They need to understand that so they can work out the details. Okay, is that going to be the right way of phrasing it, or we need to do something a little bit different? You don't want to have to explain why you have to do things a certain way. And then the other thing too with the lawyers is this: if it's that lawyer that was your college roommate and has done some contracts and has done very capable, good work for you, some corporate work for you, but is a person who's just has a shingle out there and a single operator, just one lawyer, maybe has someone answering the phone. You want to work with a firm that's going to have numerous junior people, paralegals or junior accountants or junior lawyers. Why? Because when you get into the due diligence phase, that's where the buyer is looking at all the information, confirming everything, and the lawyers are putting together the contract. You will have a massive amount of schedules that need to be prepared based on that purchase agreement. And if this lawyer has never done it before, that's a lot of work. You want to be able to pass that off to a bunch of junior people who bill at a lower rate, first of all, and will be able to get the work done. I don't want to put schedule. I'm too old for that. That's a young person's game. And that is something that is missed a lot by somebody that wants to use that capable lawyer, but has never done an M&A transaction and does not have a staff to handle all the support work. It will slow things down and it becomes penny wise, pound foolish.
Yeah, I'll tell you, this is the last little bit of that. That's, as private equity guys, once we're under exclusivity, which will often be 30 or 60 days. We're fine if that transaction strings along. We just get more visibility into the business before we have to close, particularly if it's because on the seller, can't meet the timelines on the documents we need, the schedules we need. It's, that you think you're helping yourself. In point of fact, all you're giving us is a much longer look at that business, in a reason to change our mind. If we need to change our mind, it's a mistake. You often miss a window.
Yeah. When you sell, you want to get the thing across the finish line as soon as possible, because the more time goes by, the more something can go sideways that can impact it. And a couple stops ago, some other guys were working a deal, and it was the same sort of situation. The lawyer was a long-term friend of the owner of the business. the other guys, the bankers, said you should hire a firm to handle this. No, so and so is he can handle this. Well, he was a single lawyer in his office, did not have any support staff, and that schedule, putting those schedules together, this person has never done it before, did not realize just how labor intensive that is. It dragged the process out, and a closing that was supposed to happen in January got punted to February. Still don't have the schedules done, need more time. Let's close in March. March rolls around, and the biggest customer of this company fired them. Nothing to do with, there was some consolidation going on, but they lost a massive amount of something like 20, 30% of the revenue. What did the buyer do? Well, wait a minute.
Right.
What's going on here? Pulled up stakes and left. The deal did not happen. And a deal did happen a few years later at a lower price. The business came back a little bit, but I will always remember that because of the lawyer and the business owner refusing to pay a little bit more money to hire a firm that has done this kind of work before. That ended up costing that person probably a few $1 million, all for the want of what, a couple $10,000 of legal fees.
Yeah, and we see that. It's where on our side, on the buyer side, we got a smile on our face in those situations where when the seller is telling us, hey, we want to close quickly. It's like, we can, because this is what we do for a living, folks. I'm guessing on your side, if you don't have the right service providers, you're not going to meet our timelines. I can tell you that's going to happen right now.
They always underestimate how much time is needed to pull everything together, not just the schedules that I've mentioned a few times, but just all the documents, all the things in a due diligence list. That takes a lot of time to pull together, and they don't realize it. And a lot of times business owners will look at someone like me and just say, well, just get it done. I don't need to do a quality of earnings report. I don't need to have this. I don't need to have that. Just get it done, Bill. You're so good. You get it done. They're turning it around. And I say, no, that doesn't work. You're hiring me to build a house for you. I have the labor. I have the blueprint. You have to supply 100% of the materials. And if you refuse to buy the windows and the bathroom fixtures for the house, I can get it mostly done, but it is not going to be finished until you provide all the materials I need to build that house. It's the same thing selling a company. I have the blueprint, I have the labor, but I need the business owner to provide all the materials, not just some that are easy to come up with, but all the materials needed to build that house, all the materials needed to get the deal done. And short of that, it's going to either impact the price or it might not get done because the buyer does not have all the information the buyer needs to close the transaction.
Yep, that is always a problem. All right, as we come to the tail end here, so tax implications of sellers' accounts receivable.
And this goes back to our friends.
The good news is this is very detailed. So as we talk about these things, this is a super detailed item.
This is why you don't want to have your accountant look at the price. Oh, it's $25 million price, capital gains is this for the state, it's that, there's your tax. You need to do a much deeper dive. You need to look at the purchase price allocation, what is being bought. It's just not the assets. Maybe there's some goodwill. And guess what? The receivables that are being sold are quite often, and I'm not a tax attorney or tax accountant. Okay, I've got a personality and people like me. But what you want to do is have
another
your people,
shot at the accounts.
No, because they drive me nuts. And I'll be happy to tell them that you have to do the work, because what happens is you get the yeahs. And then a few months later, when you're getting ready to close the transaction, they say, wait a minute, the tax bill is higher because accounts receivable is considered ordinary income. Okay, that might be the case. And if receivables are considered ordinary income as opposed to long-term capital gains, the receivables portion of that tax bill might be at a higher level. So again, talk to your accountants, your tax people. Do not let them do the wave of the hand and say, yeah. Have them do the calculation and ask them, here's my typical receivables. If I have $1 million in receivables, how is that going to be taxed? Have them do the work. Okay, pay a little bit of money if you have to. Have them put a report together, put their name on it so you understand, because at some point, somebody will have to do that tax calculation. And again, I see no reason why they can't, why a capable tax accountant cannot do that calculation ahead of a sale. Take some assumptions. Maybe it's not down to the penny. I don't need it down to the penny, but you want to understand that.
Yeah, and I think that's actually sometimes confusing for sellers, Bill, that we're bringing in a firm, an accounting firm to do a quality of earnings. And, typically with private equity guys of any size at all, there's a certain level firm we have to use, right? Because, if something goes awry in the deal and we hire Dewey, Cheatham and Howe, for those of you who did go to school for accounting, and if that's the standard, accounting name on any exam, we're going to be, up the creek without a paddle with our investors, right? So we're hiring a quality firm, but they are there to advise us, not to advise you, the seller, right? That's not their job. It's like the real estate agent. The real estate agent selling that house is representing the sellers. They're not representing the buyers, right? So their job is not to help you. And that's the same thing on our end. And that's often confusing for founders is, well, your accountants are already in there. Maybe they can just, give me a heads up or, give me some advice. That's not their job and they won't do it,
you're absolutely right. And the sellers have to agitate for their own good. Because I've had this before. Well, we'll just give the buyer all the information. They'll come back and, well, no, the buyer's going to negotiate from their perspective. Okay. We have to put a stake in the ground. We have to understand something. We have to explain something, and we just can't wait for them to do what's right for you, because they're not. I'm not saying that we take advantage of them or vice versa, but our job is to negotiate for you, Mr. Buyer or Mr. Seller. And the buyer's job is to negotiate for themselves. You do not want to negotiate for the other person. That's not immoral or unethical to say that. If you and I were on the opposite sides, I would expect you to negotiate hard as a buyer. I'm going to negotiate hard as the seller. I'm not going to make your deal. And you can't expect as a seller, the buyer's going to come in and make your case. When you're a seller, you have to make your own case. You're going to make your own case as a buyer. Then we can work out the details. And if we have a goodwill and honesty and all that kind of stuff, we can come up together. That's going to make sense. But I would not expect you as a buyer to negotiate on my behalf as a seller and vice versa.
Of course. Yep. But again, that's why you hire the competent professionals. Okay. Last on our list here is the seller signing a non-compete, which is, this can be a big sticking point in a deal.
It can. Yeah. A lot of times if a seller is looking to retire, look, I've been working forever and I got grandkids now, and I just want to play golf and travel and see the grandkids. That's, fantastic. I don't care. I don't plan to work again. I'll sign whatever. If the person is maybe younger, wants to build a business, the buyer is going to want some protection. Wait a minute, I'm giving you a lot of money. I don't want you to take all that money and then open up shop right across the street and compete against me with your money. So you're signing a non-compete that you're not going to be doing that. It gets a little tricky though. A lot of times buyers will want everybody to sign non-competes. And unless that employee is getting something, it's probably difficult to enforce a non-compete as well.
For sure.
And as a seller though, if you're signing a non-compete agreement, I will not compete against the buyer. Talk to your tax people again. Is that non-compete, is part of the proceeds going to be a payment for that non-compete, which might be ordinary income? So you want to talk to your tax people to make sure that whatever is applied to that non-compete, what is that being taxed at? So you understand those tax ramifications as well.
Well, that was I think a good summation, Bill. I think we're going to come back with part 2 here, next week on 10 lurking problems for sellers.
Very
in
good.
The meantime, thanks for being on today. I'll make sure all of the accountant hate mail goes directly to you. So I'm going to take you mentioned Monty Python in our earlier the pre-intro to this conversation. And so I will use when danger rears its ugly head, Sir Robin turned and quickly fled. Like I'm going to get out of the way and let them all come after you. So.
Well, no. I've talked to accountants enough, and I love speaking to CPA societies. They're great people because you can make fun of them, and they're so excited when you start I do all my accounting jokes, and they look around very nervously and they say, "Oh my God, he's talking about us." They love it. They absolutely love to be talked about because now they feel more inclusive and a part of everything. So if accountants wanted to reach out to me, I'll be happy to deliver all my accounting jokes.
Well, ciao for now. Thanks for being on.
Thanks.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with the each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat. It's the Private Equity Funcast. That equity is private. If PE excites you, let it show and do not hide it. Devin and Jim